Welcome to G Fun Facts Online. What if I told you that the key to predicting the next economic boom or bust isn't hidden in complex stock market charts, but in the decision you make when buying a car or a house? It sounds simple, but that initial lump sum payment, the down payment, is a veritable crystal ball for consumer behavior and financial futures. This single number, the percentage of a purchase price a person is willing and able to put down, offers profound insights into individual financial health and, on a larger scale, the trajectory of the entire economy. It's a hard data point that captures the often elusive psychological currents that drive markets. Today, we're unpacking the telltale heart of the economy. At its most basic, a down payment is the portion of a large purchase that a buyer pays for upfront with their own money. The rest is typically financed with a loan. It's a cornerstone of major consumer purchases, especially in real estate and autos. For decades, the traditional benchmark for a home down payment in the United States was 20%, but the reality is far more nuanced. In recent years, the median down payment for a home has actually hovered in the mid-teens as a percentage of the purchase price. The size of this payment has a huge impact on a borrower's finances. A larger down payment means you're borrowing less money. This leads to lower monthly payments and, more importantly, a substantial reduction in the total interest you'll pay over the life of the loan. Lenders see a larger down payment as a sign of financial stability and a lower risk of default. They see you as having more skin in the game. Because of this, they often reward borrowers who make larger down payments with more favorable interest rates. In the automotive world, a similar dynamic is at play. You've probably seen those zero down payment offers, which are a common marketing tool. However, a substantial down payment, often recommended at 20% for a new car and 10% for a used one, can significantly improve your loan terms. It also helps prevent a precarious situation known as being upside down on a loan. That's when you owe more on the car than the vehicle is actually worth. Given how quickly most cars depreciate, this is a very important consideration for any car buyer. Of course, down payment requirements aren't one size fits all. They can vary based on the type of loan, your credit history, and the overall economic climate. To make homeownership more accessible, government-backed loan programs often have lower minimum requirements. For example, loans from the Federal Housing Administration, or FHA, can require as little as 3.5% down. For eligible military veterans, loans from the Department of Veterans Affairs, or VA, may require no down payment at all. This data is meticulously tracked. In the housing market, organizations like Realtor.com, the National Association of Realtors, and Redfin publish regular reports on down payment averages. They break down trends by location, property type, and even buyer demographics. For the auto industry, companies like Edmunds provide detailed reports on average down payments, interest rates, and loan terms. This wealth of data allows economists to take the pulse of the consumer and identify trends with broad economic implications. Now, making a down payment isn't just a financial transaction, it's a deeply psychological one. This is where behavioral economics gives us a fascinating lens. One of the most powerful principles at work is that concept we mentioned earlier: skin in the game. When you invest a significant amount of your own capital into a purchase, you have a vested interest in its success. For a home, this means you're more committed to maintaining the property and, crucially, to making timely mortgage payments. Lenders have understood this for a long time. The psychological weight of having a major financial stake fosters a greater sense of ownership and responsibility. Conversely, there's another key concept called the pain of paying. This refers to the negative emotions we feel when we part with our money. This pain is usually more acute when you pay with cash versus credit, and when you make a large one-time payment. A down payment is a perfect example of a painful payment. But this pain can be beneficial. It acts as a powerful deterrent against over-leveraging yourself and taking on more debt than you can comfortably handle. The very discipline of saving for a down payment can instill a more realistic understanding of the long-term commitment you're about to make. The size of your down payment can also be influenced by cognitive biases. The anchoring effect, for example, can influence how you perceive a property's value. An initial high asking price can make a subsequent lower price seem like a great deal, even if it's still objectively high. Loss aversion, the idea that we're more motivated to avoid a loss than to achieve a gain, can push a buyer to make a larger down payment just to avoid the loss of paying higher interest rates over time. This brings us to the core of our discussion: how down payments act as an economic bellwether. These trends serve as a powerful leading indicator of broader economic shifts, offering a glimpse into the collective psyche of the consumer. When consumers are confident about their financial futures, feeling good about their jobs and wages, they are more likely to make larger down payments. This willingness to part with a large chunk of savings suggests people feel secure. Conversely, a trend towards smaller down payments can signal a growing sense of unease. When people are worried about job security or a potential recession, they tend to conserve cash, even if it means higher long-term costs. And these trends don't just reflect the economic climate, they can directly impact it. A surge in larger down payments can help cool an overheating housing market. On the other hand, a widespread shift to low down payments can fuel a housing bubble by enabling more buyers to enter the market, which drives up demand and prices. We have a stark, painful historical example of this: the 2008 financial crisis. In the years leading up to the crisis, there was a massive increase in low and no down payment mortgages, including risky subprime loans. A 2006 report from the National Association of Realtors revealed a shocking statistic. 43% of first-time homebuyers had financed their purchases with no down payment loans. This was a clear sign of an over-leveraged market, and it foreshadowed the collapse of the housing bubble and the global crisis that followed. More recently, down payment trends have reflected the turbulence of the post-pandemic era. In the fourth quarter of 2024, the median down payment on a home in the U.S. reached a record high. This was driven by a couple of factors. Higher mortgage rates incentivized buyers to make larger down payments to reduce their interest costs. At the same time, many first-time and lower-income buyers were priced out of the market, leaving a larger proportion of more financially secure buyers. In the auto market, a different story unfolded. In the third quarter of 2025, the average down payment for a new car fell to its lowest level in 4 years. This happened even as a significant share of buyers were taking on monthly payments of over $1,000. This suggests that while some consumers are still committing to expensive vehicles, they're increasingly stretched thin and trying to minimize upfront costs. The rise in auto loan delinquencies further underscores this growing financial strain. Economists and financial institutions, like the Federal Reserve, monitor these trends closely. While the Fed doesn't directly set down payment levels, its decisions on interest rates are heavily influenced by its assessment of consumer health, and down payment behavior is a powerful signal of that health. For lenders and policymakers, this data is a critical tool for managing risk. Lenders are in the business of managing risk, and a down payment is a fundamental risk mitigation tool. A larger down payment provides a bigger equity cushion if the borrower defaults. This is why lenders offer better terms, like lower rates and no private mortgage insurance, or PMI, to borrowers who put down 20% or more. The process has become even more refined with automated underwriting systems, which use algorithms to analyze a borrower's credit score, income, debt, and the size of their down payment to assess risk more accurately. Policymakers also have a keen interest. Government agencies like the FHA and the Department of Housing and Urban Development, or HUD, play a direct role in shaping down payment policies through their loan programs. They also use tools like down payment assistance programs, which provide grants or low-interest loans to help homebuyers cover that initial cost. This brings up a perennial debate. What is the right level for down payment requirements? Some argue that a high bar is necessary to ensure market stability and prevent another 2008. Others contend that high requirements are a major barrier to entry for many, particularly minority and low-income households who may lack access to generational wealth. This has led to the rise of so-called Nepo homebuyers, young buyers who rely on family money for their down payment, highlighting the challenges faced by those without such support. Now, while a 20% down payment has been a benchmark in the US, a look around the world reveals a wide range of norms. In many parts of Europe, a down payment of 20% to 30% is standard. In Spain, a non-resident might be required to put down 30% to 40%. In Germany, 20% to 30% is customary. In Asia, requirements are often even more stringent. A first-time buyer in China might need 30% or more. In South Korea, regulators have been tightening loan-to-value ratios to manage household debt. These higher norms can promote a more stable housing market, but they also make homeownership a distant dream for many young people, leading to a greater reliance on renting. The US, with its array of low down payment options like FHA and VA loans, is relatively more accommodative, which has supported a higher homeownership rate but has also, at times, contributed to market volatility. So what does the future hold? The world of down payments is in a state of flux. The traditional model of saving for years for a 20% down payment is being challenged. Fintech is at the forefront of this transformation. Apps and platforms now help prospective buyers save, using features like automated savings, goal tracking, and even crowdfunding. Some fintech lenders are using AI to develop more sophisticated underwriting models, potentially opening the door to more flexible down payment options. Demographic trends are also a major factor. Millennials and Gen Z are entering their prime home buying years, facing unique challenges like high student loan debt and an unaffordable housing market. As a result, many are turning to non-traditional sources for down payments, like gifts from family. The economic environment will, of course, continue to be the primary driver. In a high interest rate environment, we'll likely continue to see larger down payments as buyers try to minimize borrowing costs. If the economy enters a downturn, we could see that shift back towards smaller down payments. The role of the down payment as an economic crystal ball is likely to become even more important. The willingness of a consumer to part with a significant amount of their savings is a powerful statement of their confidence in the future. By paying close attention to these trends, we gain a deeper understanding of the forces shaping our economy and can make more informed decisions about our own financial futures. The down payment, far from being a simple hurdle, is a rich and revealing data point that offers a glimpse into the very heart of the economy.